Hello, good morning. Nice and rainy today. So today we will talk about the last topic of chapter 18, and it will be the last new topic for the full midterm material. So midterm will cover up until end of today. Okay, so that's the last topic of this chapter is income tax loss carryover benefits. Okay, so how tax works is, the corporations run its business, and if it's profitable, if a revenue exceeds the expenses, the corporations have to pay tax. What happens if a company suffers a loss? Okay, obviously, the corporation should not pay tax in that situation. And in fact, the corporations get a break. However, this break is not simply, well, you have taxable income, you pay tax, you have a loss, I give you money. That doesn't work that way. So this break takes the form of an income tax loss carryover. Okay, so you can carry it back and you can carry it forward. And you can carry back up to 3 years. You can carry forward up to 20 years. And how does company get a break by carrying it back or forward? So different, like carry back and carry forward, somewhat different. So if the company have taxable income in previous 3 years, they would have paid the tax. And when you carry this loss back, you will revise the tax return you filed in the previous years. And so you will reduce your taxable income. You will recalculate it. So now I can use the loss carried back to offset the taxable income of previous years. So with that revision, your tax you have to pay will could be reduced to 0. Since you already paid tax in previous years, you get it back. So that's how the carry back works, okay? So when applying the loss carry back, it is usually applied against the earliest available income, because you can only go back 3 years. So there's a situation, how do you use this loss to maximize your benefit, right? Like the loss up to 3 years, you can carry it up to 3 years back, and there's the expiration date, this is just a practical consideration, how to maximize that. So prior year's tax return are refiled, reducing prior taxable income with the current year loss, right? And so since the taxable income now will be different, probably lower, probably 0. So tax you should have paid would be either less or none at all. But given that's already paid, you get it back. So you accounting journal entry would be income tax receivable, debit, it will be sure to become cash, and credit current tax benefit. Now, this current tax benefit, we may need to think a little bit why it's called the current. Why it's called current, because this is related to previous years, it's realizable this year because you get tax refund pretty soon, right? It's due immediately, and it may take a little time for that to go through, but it's due immediately. So that's why it's called the current, okay? So in other words, it's not if you have loss, government will pay you, but instead, if you have lost this year and you pay the tax in previous 3 years, you can get that back. That's how the break comes in. Now, if you have lost more than previous year's taxable income, you can carry forward as well. Okay, so what kind of benefit you will get if you carry tax loss forward? Well, similarly, if you generate taxable income in the future, you will have to pay tax, right? Now, by carrying the loss forward, you can use this loss to reduce your future taxable income. Okay, so when you file future tax returns, you calculate the future income. And if you have loss carry forward, you can subtract that from your future taxable income. Hence, reduce your future taxable income, hence reduce your future tax payable. That's the benefit. Now, a key thing to remember here is that you are carrying loss forward. Okay, so remember we talk about the tax rate could be different from different years. So therefore, the benefit of these laws would be dependent on the tax rate of future, right? Because it's a future year's taxable income will be less, and therefore, like if future year tax rate is higher, your benefit will be more, because without it, you will have to pay more tax. If future year tax rate is lower, then your tax benefit will be lower accordingly. So this, now, in order to realize this benefit, there's a condition. You have to actually have taxable income in the future, right? Like if the business gets worse and worse and worse, and you know, you never earn taxable income, then you don't have to pay tax to begin with. So this tax loss will make no difference. So that's why a tax loss carry forward can only be recognized if it's more likely than not that the benefit will be realized, i.e. company will generate taxable income in the future to apply loss against. Okay. Now, say if that's true, it's more likely than not the benefit will be realized, then you can say, well, I will have a future tax benefit. It's called the future tax benefit because it will be realized in the future, right? The future tax to be paid will be reduced because of this. So your journal entry would be, you create a deferred tax asset, okay, and you record the deferred tax benefit. So as a result of having loss, you could have tax benefits in two parts: current deferred current tax benefit, that's tax due to you immediate, tax refund due to you immediately, and deferred tax benefit that will be realized when you earn future taxable income and you apply this loss to that future taxable income. Okay, so and when future comes, you do earn the income, and then so your accounting income would be adjusted with this loss carry forward. So your tax paid will be less. So that you will use your deferred tax asset, credit, and your debit deferred tax expense. So your future tax expense is based on future earnings, but you only need to pay the part that remains after the tax loss is applied to it. It's subtracted. Does that make sense? Example. So here's the example. Say we have a corporation, coal corporation, reported the following accounting and taxable income. Let's just focus one thing at a time. Assume there's no other permanent or temporary differences for the first 3 years of the operation. So there's no deferred tax at the beginning of this thing. That's what I say. So the first year there's an income of 40,000, and second year is a bad year. They had a loss of 360,000. And then third year, things get back on track, 400,000. Okay, so let's assume tax rate for 2019 and the 2020 is 40%. Okay. Oh, okay, sorry. That was fine. 30% for 2019 and 2020, and 40% for 2021. So that's just assumption, right? And the COE elects to use carry back provisions first and then carry forward. So they only have 1 year before the loss, so they can only go back 1 year. There's no earnings in before 2019, so that's fine. And then so we assume that future, so when you stand at 2020, there's a loss year, and you have to recognize loss carry forward. Let's assume the estimate is such that we will be able to realize the benefit. Okay, so that's it. So how do we record this? So first, let's record 2019. Just go through the all the years in sequence, right? So 2019 was simple. There's no deferred tax because we assume there's no differences. So we will just debit income tax. It's actually, to be clear, current tax expense, right? That would be based on 30% on $40,000. So that's $12,000. And that will be paid. Let's say tax payable, 12,000. And this will be paid. This will be paid. Okay. So we talk a lot about deferred tax assets, deferred tax liability. Actually, at the end of accounting period, on the balance sheet, in addition to those deferred tax assets, deferred tax liability, a lot of times you have this tax payable. It's just how you know how it works, right? You can't determine tax accurately until the period is ended, but you need to prepare financial statements for end of the period. So there's a lag, right? So this will be on balance sheet as well. It's accrued expense, like wages payable, interest payable, or the other accrued expense, right? Yeah. So that's 2019. So let's just move it to great. Add another slide to do this. So 2020 we have a loss. We have a loss. And that's like we can carry it back first. So 2022 record tax loss carry back. So that means we're going to revise 2019's tax return, and so we can reduce taxable income to 0, right? But since we already paid, so we'll have tax refund. Oh, sorry. We'll have tax refund receivable. Okay, receivable. That's the 12,000 we paid. Now it's receivable. And what do we call it? We call it current tax benefit. Okay, by the way, how this 12 is calculated, this same thing, right? So you carry, okay, so you carry it back. You carry back 40,000 to previous years, reduce previous year's taxable income by 40,000, and the previous tax rate is 30%. So that means that will, you know, the 30% you paid will be refundable. So that's how it works. Okay. Also in 2020, we still have tax loss left, and we will this. So also in 2020, the remainder part tax loss carry forward for the balance. So that will be, we have 360,000 loss. Yes, 360 loss, and we carried back 40,000. 40,000. So that means we have 320,000 loss left over to be carried forward. Okay, so that's the amount. When this amount is carried forward, it will reduce future taxable income by this amount. And the future tax rate is 40%. So therefore, future tax benefit is going to be 340,000 at 40%. And that will be 128,000. Okay. So the journal entry for that would be debit, deferred tax asset, 128,000. Okay. Since this is a benefit pending, so we create assets that has potential future benefit. Okay, and what do we credit? Deferred tax benefit, yes. And that'll be 128,000. So put these in a different color to highlight that. So these are two journal entries. The rest were just the note of our discussion. Okay. So that's done. So in the income statement, down the income tax section of the income statement, we will have what? We'll have so 2020 income statement tax section. We'll have this. We'll have income before income taxes. And that would be a, well, I should say income or loss, because that's the year we have a loss. Always start with the loss, but I don't know why I include income since there's no income. But anyways, if there's income, there will be income, but we don't. So that's a 360, right? That's the loss year, 2020, right? And then we have income taxes, and they'll have two parts. We'll have two parts. We have the current part, and that is income benefit, income tax benefit, current income tax benefit, that you will be refunded shortly. That's 12,000. And then you will have deferred. This will only be realized when future taxable income is earned. So that gives us a total. It would give us a total of 140,000. And so that year's net loss would be 220,000. So this net, the total tax benefit, so I was income tax benefits, probably that's a benefit, income tax benefit. If you look at this, what's the tax rate? It's neither 30% nor 40%. It's combined, right? This portion is computed using the 30%. And this portion, because this portion is realized right away, it's based on the prior year's tax paid. So it's calculated to use prior year's tax rate. Now this deferred part, 128,000, is going to be realized in the future. So the tax benefit is determined by the future tax rate. So it's a 40%, right? So if you divide the 220 to 365, it's between 30 and 40%. Okay, so let's continue with this to 2021. Okay, so in 2021, we have, again, we have a good year. We have earnings of 400,000. Okay, so we can apply tax loss carry forward. We can apply entire $320,000 loss carried forward. That's what we determined, right? So that will reduce our tax payable by 320,000. So income before tax is 400,000, and we have subtract loss carry forward. We're going to use that's 320,000. So the difference would be, this will be the tax payable of taxable income. So that's 80,000. And so therefore, tax payable would be 40%, 32,000. Tax payable, add 40%. That'll be 32,000. Okay, so the journal entry for this year would, for the current part, would it be current income tax expense will be 32,000, and that's tax payable. It's called current because that has to be paid due immediately. due currently, right? But also, the reason we only pay so little is that we applied this tax loss carry forward. So we use the benefit of this loss carry forward. And if we used it, then we have to remove the deferred tax asset because it's used, right? So the second part would be for that amount, we have deferred tax, income tax expense, deferred income tax expense, that's 128,000. And that's not paid. It's covered by the loss carry forward. And the benefit of the loss carry forward is reflected in the deferred tax asset. And now the benefit is realized, we remove deferred tax asset. So that's our journal entry. Okay, so now let's look at what income statement will be like. Income 2021 income statement. Tax section. Okay, so we start with income before taxes, and this year is income, so it's 400,000. And again, we have two parts of income tax. The current part that needs to be paid is 32,000. Deferred part is 128,000. It's deferred from future, from past, right? So it's called deferred. It's just that's not current. We do not pay that this year, and then therefore, the total income tax. The total income tax expense is 160,000. Now, so maybe I should just be clear. These are tax expense, so I'll put a negative sign here to distinguish them from the income. Okay, so net income for this year is going to be 240,000. Okay, so so if you look at the total tax, because of 1 year, the total tax is 160,000. It is 40% of your tax, of your accounting income, right? It is because that's, you have those earnings, you should pay tax, but you only need to pay 32,000 because you have loss carry forward. Okay, so 128,000 out of that 160,000 you do not have to pay because the previous year's loss carried forward, offset it. You use that loss against the taxable income of this year, reduce the tax you have to pay. So that's how the benefit is realized. Does that make sense? Okay, so just sum it up. Like when you have income, you pay tax. When you have loss, you can use this loss to get tax you paid in previous 3 years back. That's called the income loss carry back. And if you don't have to do that. This is just, you have option to do that, and then you can also carry the loss forward. And so, should you carry it back first? Should you carry forward first? Depends on a lot of things. one of the things like for in this instance, if you're confident the company is going to do well in the future, probably it's better off to carry it forward because future tax rate is higher, right? So for each $1,000 you carry forward, you will save tax $400. You carry back, you only save $300. So that's consideration. And another consideration will be like, what's the outlook of the future? If even though future tax rate is higher, but if you don't think you will earn sufficient income to benefit from that, and rather than losing it, might as well do that. Time value of money may be concerned. I need money now. I want to get cash refund now, right? So there's a lot of concerns the company would have to consider all that with the idea to maximize the benefit. By the way, so this is the to carry forward the 20 years. Remember during the US election, it came out like Donald Trump has not paid tax for like over decades. And this is pretty much the mechanism. So like, I think he had the casino lost $1 billion sometime in the past, and he has been using those laws carry forward and avoiding paying any tax for over decades. Okay, so that's pretty much this at work. Okay, so now let's look at this with the condition to recognize deferred tax benefit is that we, it's more likely than not, there will be sufficient amount of taxable income in the future so you can realize the benefit, right? You don't get any benefit automatically just because you have a loss. It's if you have taxable income in the future, then that's the condition you can use those laws to benefit from it. What if future tax income not likely? Okay, so then you cannot this is the potential remains potential, right? You cannot realize it. And so the treatment here between IFRS and ASPE is a little bit different. So under IFRS, since you more likely than not, you will not be able to realize the benefit, then you cannot recognize it. If you can't realize it, you should not recognize it. Doesn't mean you don't have this loss carry forward. You just can't debit deferred tax assets, credit deferred tax benefit. You can't do that. You can't recognize it. But the loss is still there. Okay, you don't have to give up that loss. If your estimate is wrong, if things happen to be better than you expected, you can still use that loss. You just can't put it on your financial statement now. Okay, so then do not record tax benefit. Instead, report existence of loss carry forward in note to the financial statement, not the financial statement proper. Does that make sense? So there are two issues from tax purpose. You have a loss, then this loss does not expire for 20 years, okay? But for financial reporting purposes, the benefit of the loss can only be recognized in the financial statement if it's more likely than not you can realize it. Otherwise, you cannot put it on the financial statement. You don't have to give up this loss carry forward, but you just can't recognize the benefit. Does that make sense? Yeah, it makes sense, right? So you need to disclose the amount and the expiry dates of unrecognized income tax assets related to the carry forward of unused tax loss. Okay. If the tax loss carry forward was not recognized because the estimate is like the future is not going to be very well, but turned out the company does generate taxable income in the future and actually uses the unrecognized loss, and then you just reduce the future taxable income, right? You still can pay less tax. You still can use this tax loss. So in the future, the taxable income will be just less. And so here would be what it looks like. So same example. So now we change the assumption with based on, so this is the different part of assumption. Everything else the same. Here, this part is different. Based on the estimate of 2020, that's when you recognize deferred tax benefit, current debt tax benefit. It is unlikely the benefit of loss carry forward will be realized. Okay, so therefore in 2020, the journal entry will be different. You cannot, in 2020, all you have to do is to record the tax refund receivable. So all you have to do is tax refund receivable. That's the same 12,000 as we determined before, and current tax benefit 12,000. No deferred tax benefit. So therefore, 2020's net loss will be a lot higher than if you recognize the deferred tax benefit, right? Okay, so then what happens in 2021? I don't know why these are smaller. I know why it's smaller. I'll fix it. I don't like it, I'll fix it. Okay, so that's because. Okay, so in 2021, we happen to have more income now. We could use the tax loss, so we use tax loss even though we didn't recognize, right? So the computation will be same. We have 400,000 income. Didn't expect that, which is just fine. But now I had income, I have to pay tax on it. But I do have tax loss that I did not use yet. That's 320,000. Use it just the same. Reduce my taxable income to how much? 80,000, right? So we still use. So income is, so then maybe let's do it for the next slide. So this slide. Oh, don't do that again. I'll delete all that, continue with that. So 2021, the income, this is accounting income, is 400,000. And we use tax loss just the same. Tax loss carry forward. It's still tax loss carry forward, even it's not recognized. Okay, and that's 320,000. Use it just the same. And then so our taxable income will be 80. And the tax payable, add 40%, would it be 24,000? No, 32,000. 32,000. And so the journal entry would be simply debit current income tax expense of 32,000, income tax payable 32,000. What's the difference between this two and the one that we did with the assumption from day one that the future tax benefit will be realized? Okay, what's the difference between the two? You pay the same amount tax each year, right? You get the same tax refund each year. The only part that's different is when you think the tax benefit will be realized, you recognize the benefit right away. So your tax benefit for year 2000 is $128,000 higher, but then your tax expense is $128,000 higher for the next year. So you basically move that $128,000 between the 2 years. You recognize benefit in 1 year and you same amount of expense in next year. When you don't think future tax benefit will be realized, there's no this shift of $128,000. You don't have the deferred tax benefit of $128,000 in year 2020, and you don't have the deferred tax expense of $128,000 in 2021. That's the only thing different. You know, if you look at the 20 and 21 together, it's the same. You get tax refund of $12,000 in 1 year, and you get tax paid of $32,000 in another year. Does that make sense? So it's like the creating this deferred tax asset actually shifted that $128,000 from 1 year to the other. And by not creating that, you did not have deferred tax benefit, deferred tax expense. They offset each other, and it was timing this reversed, right? So with that, we create this deferred tax and reversed that next year. Without that deferred tax being recognized, you did not create a difference to begin with. So there is no reversal either. Okay, so think about that. Okay, so that's if first. If you in the future does not look good, you can't recognize deferred tax benefit. Okay, just keep track of that. If you can use it, but don't recognize it. For ASPE, essentially the same, but the mechanism to recognize that is a little bit different. So under ASPE, you use this valuation allowance account. Okay, so if it is not likely that the benefit will be realized, deferred tax assets from loss carry forward can be reduced with a valuation allowance. And this is not allowed under IFRS. This is the way the ASPE used for. So this is a different example. So for instance, you have a loss carry forward of 150,000 and you have 20%, right? So as long as you have loss carry forward, you can recognize the deferred tax asset of 30,000. That's 20% of the loss, and the deferred tax benefit of 30,000. Now, if it's not likely, it's unlikely that the benefit will be realized, you can't carry this asset. Accounting conservatives requires that. So what do? You write it down, but you not remove this account from the balance sheet. Essentially you did, but you create a contra account called the allowance to reduce future income tax asset to expected realizable value, which is 0 in this case. So you have to reduce deferred tax assets altogether. remember asset and the liability approach. If you reduce asset, you increase your expense, right? So you have deferred tax expense, debited 30,000. And think of what happens to your income statement. These two guys offset each other, right? These two offset each other. So isn't that what happened under IFRS? We didn't recognize deferred tax, right? It is the same. And on the balance sheet, you have a deferred tax asset, and then you have allowance, valuation allowance, which reduce it to zero. So there is no difference in essence, in the net impact on financial statement, but the presentation is a bit different here. Okay. Okay, so so let's take that valuation allowance or like the measurement of deferred tax assets a little bit further. So like all assets, deferred tax assets must be reviewed at year end to ensure that the carrying amount are appropriate based on existing conditions at the statement of financial position date. So this is like, what's the accounting principle behind this? And this is not like a unique in a way. We have seen a practice like this in other places as well, right? Like an impairment. Yeah, we test the impairment, lower for cost of market for inventory, right? It's all same idea that you should not overstate good things. You should not understate bad things. You should not postpone recognition of bad things, and you should not prematurely recognize good things. Accounting conservatism, right? So like, for instance, for contingent loss, we recognize if certain conditions are met, but we don't recognize contingent benefit, right? Contingent gains. So if we're being sued, then we have to assess the probability of a decision or judgment will be against us. And then as a result of that, there may be loss, there may be payment we have to make. And then if it's probable and if it's estimable, we recognize contingent loss and contingent liability. But if we are suing, no matter how likely we're going to win settlements, we don't recognize that until it is, becomes realized, until we actually get payment, right? So it's the same idea. So loss, deferred tax asset, carry forward, due to loss carry forward should be assessed to see if the benefit will be realized, same as all other deferred tax assets as well. Okay, same as for all the others as well. Okay, so that's just that. And so that's just summarize. So in relation to the income taxes on the balance sheet, we'll have tax receivable or payable, which we do not emphasize enough because it's kind of a more straightforward. So that's, as we said, the lag means at the end of fiscal year and the financial position date, receivable, payable are still pending usually. So that's will be recognized just like any other accruals, right? And these are usually would be current, and this usually will be separate from deferred tax. And then you have deferred tax assets liability on the balance sheet as well. Okay, the tax receivable, tax payable are reported as current, shown on a gross basis unless there's a legal right to offset. So you could have tax refund, you could have tax payable, means you do not net it. You do not net it unless it's related to the same thing. So that's, I think that's, again, we have seen that. Remember when you have cash, you have like a checking account, it's cash, but then you have overdraft, you do not net it unless it's related account. Remember that? So this is the same thing. Okay, so about the deferred tax asset and liability under IFRS, they are all non-current. They are all non-current. That's it. Under ASPE, they should be separated between current and then non-current. Because if you think about it, deferred tax, some can reverse within 1 year. And if they reverse within 1 year, then that's current. That fits the definition of current assets and current liability, right? Current assets will be used or removed within a year, and current liability will require payment in a year. So, but under IFRS, we don't do that. So that's another difference. On the income statement, tax expense reported with its related items such as discontinued operation, other comprehensive income, adjustment to retain earning, etc. Okay, so actually before we go that, that's first mentioned that income tax section, we have current and deferred. Don't forget that, current and deferred. So that sometimes you see it right in the income statement, sometimes in the footnote. Okay, so that's it. But also there's this thing called, this is called the intra-period tax allocation. What is the intra-period versus inter-period? Intra-period is within the same period, whereas inter-period will be among different periods. So deferred tax is inter-period tax allocation, right? We move it from one period to the other. So intra-period is within same period for different different source of your income, major income segment, the tax are separated. Okay, so typically you will have, if you have mostly it's discontinued operation, the tax on the discontinued operation, the gain or loss will be separated from continuing operation. Okay, so discontinued operation is always reported net of tax. Does that ring a bell? Net of tax. So it means if you have a loss, and what that will reduce your tax payable, right? Taxable income. And then so the net of tax loss will be smaller than the before tax loss. And so this tax is not combined with other tax. This tax associated with discontinued operation will be separated. And the other category would be other comprehensive income. Okay, remember other comprehensive income usually are unrealized gain loss, right? Like from the four things: foreign currency exchange, I think hedging derivatives, pension related, and there was one more, available for sale type of investment. But they were all unrealized gain losses. So none of the tax will be actually due. So they were all deferred tax, right? But there is tax implication to that. And so they will be separated. So for instance, here's the example what it will be like. So for instance, we have a situation that Copy Doctor Inc. Has a tax rate of 25%. And they have before tax earnings from continuing operation. So be revenue minus expense, minus gain or losses, you know, like that. But what's not included in there is loss from discontinued operation. And they also have 25,000 other comprehensive income. It's related to fair value through other comprehensive income. That will be only thing that would fit in that category. Now it's investment in debt securities, and is classified as available for sale, right? So for like investment in equity securities, it's all the same now. Whether it's trading or available for sale, it's all fair value through net income. The only investment can be accounted using fair value through other comprehensive income is available for sale investment in debt security. Okay, so that's that. So with that kind of a earning structure, the tax will be separated into two parts. So from the 25%, from earnings before tax from continuing operation of $500,000, the tax will be 125 here, right? Now, the loss from discontinued operation, that's 320,000. Remember, that's the total gross loss, but there is a tax benefit, 25% of that, that's 80,000. So discontinued operation is reported net of tax. Tax is already subtracted. Okay, so therefore your net income was 130,000. So here, the intra-period tax allocation means some tax are here and some tax are here. Okay, they are allocated. And then you also have this unrealized loss. Is that, no, sorry, it's unrealized gain. Unrealized gain, other comprehensive income of 25,000. Okay, that doesn't go into income statement. This is going to statement of other comprehensive income, but tax up, subject to tax nevertheless. So the tax, this will be deferred tax, right? Is $6,250, and that will be subtracted here. So your tax, income tax actually allocated into three parts, right? You have this part and this part. And this part. So that's called the intra-period tax allocation. Okay, intra-period tax allocation. Why do we do that? What's the point? Well, why do we separate discontinued operation from continuing operation to begin with? Because, you know, go back to conceptual framework that useful accounting is supposed to provide useful information, and useful information should be relevant and reliable, and predictive value is one of the characteristics of relevance, right? If the information should help us to have a better idea what's going to happen in the future. More specifically, what happened in the past can be an indicator of future if we believe these occurrence is reoccurring. Okay, so therefore, when we look at the income statement, we kind of one of the things that falls into the category of quality of earnings. Good quality of earnings are reoccurring earnings from your core business, like sales revenue, like your cost of goods sold, operating expense. Those are all reoccurring. Some are less reoccurring, such as restructuring charges. This is supposed to be a major change happen once in a while to turn things around, right? So that's less recurring. Discontinued operation, discontinued, not reoccurring. So that's not going to be part of the future. because it's discontinued. So separating out is supposed to make the income statement more useful, okay? Because anything from continuing operation by definition will be more persistent, and discontinued operation is not persistent at all. It's going to be gone. It's still here hanging on for a little while, but it's going to be gone, right? So by reporting the net of tax, if you want to remove this item from your analysis, you can just ignore this item altogether. Otherwise, if you want to remove that, you have to say, wait a second, if without that, the tax will be different, right? Without this loss from discontinued operation, the tax will be different. So then you it's not a clean separation. Okay, so that's the idea. Does it make sense? Yeah. So okay. So that's I think that's all for today. And what I will do is let's look at a footnote of, where is it? So many things open. A footnote of a real company about how the income tax is reported. Close this. What else is opening? I'm going to close this. So when too many things are opening up, like that thing like here, where is that? I have it. See, this is. Oh, thank you. Yes. Yeah, here it is. Okay, so unfortunately, this would be just from like the annual report, so it's kind of a small, and this is as large as I can go without. Let me see if I can go even. Yeah, I guess it's okay. It's on the bright space, but let's just see. Is that okay? You see, okay. So this is the footnote number 16. This is Brookfield, and this, I think Brookfield is the company that the textbook used as a comprehensive example, okay? It's kind of not a typical company. Brookfield is a property management company. So its business model is they have lots of like buildings, shopping malls. So that kind of business, right? So you can see from this part of the annual report. So the first part, they have, as I said, income tax, current versus deferred are separated. And here's the income tax. The current part for 2014 is $114 million. And the total income tax is $1,323 million. So they only pay about 10% of their total income tax. And that is unique in a way because this company's assets, like vast majority of its assets are buildings, are real estate properties. And remember that one of the big temporary difference is between depreciation and the CCA, right? And so the company take a full advantage of that. They have deferred, this is what that will be increase in deferred tax liability, right? That's the increase in deferred tax liability of the year. That's not total deferred tax liability. Okay, so that means whatever the tax rate it is, there's a huge excess of CCA over depreciation. Okay, and so that's that. And were arising from previously unrecognized tax assets. Remember, we said that tax assets sometimes are not recognized if we don't think it will be realizable, but our example just go, oh, we didn't think it will be realizable. Oh, we realized, but there could be a step in between. Say 2020, we go, oh, future is going to be bad. There's not going to be taxable income. And in 2021, you may not earn all the income but the outlook changed to say, you know what, I think the future will be fine. And like, we will have taxable income. So if that, you can reverse, you can say, well, we have all this tax loss carried here. We didn't recognize any tax benefit. You can recognize it. You can make adjustment. So, and then when, you know, realize you can use it, right? And then this part is related to change in tax rate. Remember, we said if that happens, your future tax liability or asset might be different, and you should make adjustment, recognize all that in that 1 year. So all in all, the deferred tax is $1.209 million and total tax that much. You know, so this is kind of unique, like the opportunity created by the CCA allow this company to defer loss of its tax. Okay, and then this part is, do we know what the effective tax rate, statutory tax rates are? So we know statutory tax rate, that's the tax rate that the government, like it's written in the tax act, tax regulation, right? So like, for instance, I do not know what Canadian tax rate right now, 26, I guess that's 26%. In US went from 35% to 21%. So that is same for every company, okay? Same for every company, but the tax regulation is very, very lengthy. So there are tax credit given to various things. So for instance, if you, if you export your product, there's tax credit for that because government want to encourage that kind of business activities. If you invest in research and development, you may have tax credit for that. If you work in the field that create environmental friendly energy or something like that, you may get a credit. So there's various things government use tax policies to encourage certain behavior and discourage other behavior, right? So as a result, that certain items not taxable, certain items taxable at lower rate, maybe something are taxable at a higher rate too, right? So therefore, all these changes, these are permanent differences, right? This will be permanent differences. And so result you actual tax paid, if you compare that to income before tax, it will be at a different percentage. So this is called effective tax rate. So this effective tax rate is simply the actual income tax divided by income before tax. Okay, so that's the difference between statutory tax rate, which is same for every company, versus effective tax rate are the permanent differences. And the effective tax rate will be different from one company to the other. And even for the same company, it could be different from year to year. It will depend on the situation of the year. So that's that part. You need to reconcile your effective tax rate with the statutory tax rate. So let's see what's in here. So for instance, this year 2014, right? There's here international operations subject to different tax rate. And that reduced the tax by 5%, kind of equivalent, right? And the next one, I don't like ignore that one. It's hard to explain. This one, change in tax rate and the new legislation that increased 4%. Okay, that doesn't have to be changed in statutory tax rate. So simply be change in tax on certain items could resolve that, right? So that's like that. So here are the details of deferred tax assets, deferred tax liability. Okay, deferred tax assets, deferred tax liability. So these first four, these are all kind of unrealized losses, and they give rise to deferred tax asset. Positive number is asset, negative number is deferred tax liability. So why unrealized loss give rise to deferred tax asset? We can actually like work through it. So when you have a loss, realize or not, if that reduce your accounting income. Yes, when you have a loss, reduce net income, accounting income. However, if these loss did not require payment of cash, that does not reduce your taxable income. Yes, right. So therefore, that your accounting income will be lower than taxable income. And in the future, your taxable income will be lower. So these are deductible differences. If they're temporary difference, they're included in accounting income now, deducted now, but not from your taxable income. When they reverse in the future, it will reduce future taxable income. So these are deductible differences, and deductible difference give rise to deferred tax asset. Okay. The last one, the big one, is the difference in basis. Okay, so this one is not very self-explanatory unless you put it in context that this is a real estate management company, real estate holding company. So the basis they were talking about is the difference between net book value of their properties and the UCC, undepreciated capital cost. Okay, that's a difference. But as we said, usually your UCC will be a lot less than net book value, because there will be to your benefit to use a salary depreciation, right? And so therefore, that this is a future taxable amount and give rise to deferred tax liability. I think that's good for today. I'm always get carried away and they're too long. Today I was finished on time. Okay, so I think that there's a quiz for this week. Just mind you, this quiz is not as easy as the previous quizzes. Okay, just remind you that. And then there's an assignment which is due in the middle of next week, and covered all the like up to today's material. So next week we will just get ready for the term. All right, you guys have a good weekend. See you next week.